Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm joined by Zach's Director of ETF Research, Nina Mishra, to discuss how you can invest in this hot IPO market. There's all these new things being thrown around, the SPACs, we have direct listings, we have the IPOs. I looked up some stats to see what exactly was happening because I kept hearing all these headlines like, oh, September was like the hottest month in like 30 months and all this stuff. So I was like, well, how does this really compare? So far through October, this is October 6th, we're recording this on 2020, there have been 286 IPOs so far. Now that compares to 2019, where for the entire year, there were just 233. So this is hotter than last year. And last year got all this publicity because we had like Uber and some other big name companies that were like the unicorns went public. I actually found some articles from like the Wall Street Journal talking about how was 2019 another 1999? Well, no, not with only 233 IPOs. So it kind of fizzled out there at the end of the year, I feel, in 2019. The last time we had over 300, which looks likely here in 2020, was in 2014, where some stat I found had 304 that year. But the big kahuna still remains 1999, as the Wall Street Journal was alluding to for that article last year, with 547 IPOs. And that raised $107.9 billion in funds in 1999, but we've got to be at least close to that between IPOs and the SPACs, because I saw a stat that by October here, the SPACs have raised $22.5 billion on their own. So a lot of money being raised by a lot of people, Nina. And now we have the ETF industry diving in, because they always do. We can depend on them to dive in there, and they've launched a SPAC ETF, which is what I asked you to join me on for the show today, and also to talk about what else we can buy for the IPOs as well, because we haven't covered this topic in a while, and we certainly haven't covered the SPAC. So what is with the SPAC ETF?
Hi, Tracy. Thanks for having me on. And yes, as you mentioned, the IPO market is really hot this year. In fact, 2020 could be one of the busiest years for IPOs on record. And there are two IPO ETFs. One of them has done really well, and we will get into those two ETFs later. And we will also discuss why the difference in performance. But let's talk about SPACs first. Yeah. So the SPAC market has also been very, very hot this year. And in fact, I just read that 116 IPOs through SPACs have raised 44 billion this year. And that is more than past 5 years combined. And that is according to Barron's. And they got that data from SPAC Insider. And some of these companies which took the SPAC route to go public, including for example, Virgin Galactic and DraftKings, they have delivered excellent performance this year. And that is why there's a lot of interest in SPACs, and some very high profile, investors, they have formed their SPACs. So that is, for example.
Yeah, let's talk about what a SPAC is, though. Like you mentioned DraftKings and Virgin Galactic, and I was looking up another one that just announced that it's merging with a SPAC, Lordstown Motors, which makes those electric pickup trucks. So they're kind of in the news too. So what happens is, like, the holding company that doesn't own anything goes public first, right? Like they go public through the SPAC, which means special purpose acquisition company. And they don't really own anything, but they're just raising the money through the SPAC to go out there and acquire something. So that happened with Lordstown Motors. So I guess it was Diamond Peak Holdings was the SPAC. And then they announced in August that they were acquiring Lordstown Motors, and that will close in the fourth quarter. And then Lordstown Motors will be the publicly traded company. So it's a way to get them into like have their own IPO basically. And they're funded, and now they're going to trade under the ticker RIDE, RIDE apparently. So that's what's happening with some of these. I did a whole podcast on just the blank check SPACs that haven't announced who they're acquiring yet, because I got a question about whether or not people should buy those SPACs. And it seems crazy to me because you don't know what they're even going to buy. Like, I did not know Diamond Peak Holdings was going to buy Lordstown Motors like a couple months ago. I had no idea. So why would I buy it? But now I know that it's buying the Lordstown Motors. Now, doesn't the ETF, it has a difference in there, right? Like what they're owning in the SPACs?
Right. So the ETF will allocate 80% to companies that have already gone public through SPACs. So companies like Virgin Galactic and DraftKings. And 20% will go to the blank check companies that you talked about a little bit earlier.
Like Peak Holdings could be in that 20.
Yes. Okay. Yes. So they have certain liquidity and market capitalization requirement. So very small, less liquid SPACs will not be included in the ETF. Okay. So that is one good thing for investors. But still, there is a question whether there are enough IPOs that have taken the SPAC route to go public, whether there's enough companies that have taken the SPAC route to go public to be included in the ETF. So what we get in this ETF is a fairly concentrated portfolio. So that is one concern with the ETF, though, for investors who are interested in, investing in these newly companies which have taken the SPAC route and have not taken IPO or direct listing route. So this ETF is a way, because those companies like DraftKings and Virgin Galactic, they don't get included in the IPO ETFs.
Okay, that's the other question. That's good to know.
Yes.
I did things.
Yeah, go ahead.
SPAC, and the ticker, by the way, is SPAK, not with the C at the end. So they used SPAK. But DraftKings is the number one holding right now, and it's 18.75% of the portfolio, and there's only 36 holdings.
Right. So almost 1/5 of the portfolio is in DraftKings. DraftKings performance is going to determine the performance of ETF a lot.
Yeah. Now I see the expense ratio is 0.45. That doesn't seem, overly expensive for something like this.
No, it's pretty reasonable for an ETF which targets, for a thematic ETF which targets a very specialized area of the market. So expense ratio is not a concern. The ETF has gathered about 11 billion in assets, and it's just started trading last Thursday, so just a few days back. So that is not an indication whether it will be able to gather assets going forward or not. But as of now, if investors are interested in this ETF, I would recommend that you wait for some time till it gathers enough assets, because ETF providers, they have been coming out with a lot of products because there is a lot of competition in the ETF market. So instead of launching plain vanilla products, which cannot compete with established market heavyweights, because you cannot launch an ETF like SPY or QQQ and hope to survive. So ETF providers have been launching these thematic ETFs and just trying to see what attracts investor attention. And there are some new ETFs, some new thematic ETFs which gather investors' attention. For example, sports betting ETF, which has managed to gather more than 130 million in assets this year, and telemedicine ETF, which has managed to gather more than 300 million in assets within a few weeks of its launch. So they keep on coming with these interesting products to see what sticks. So this could be one of those. So just wait for some time. Let's see if it gathers assets, what kind of holdings it has, whether they are able to filter out companies like Nikola well in time. And also, when you have a new ETF, it makes sense whenever you trade to use limit orders, if at all you want to trade in that ETF. But I usually recommend that you wait for some time till it gathers about 50 million in assets, so that at that point you are kind of assured that the ETF is going to survive.
Okay, that's really good advice. So this one is done by Defiance, and as you said, they're all doing these thematic ETFs, but they are the first one in. And that does give them a little bit of an advantage, doesn't it?
So that is what we saw in case of marijuana ETF, the first to market, which had taken an unusual route actually by changing the index MJ, but that was able to quickly gather assets. And similarly, that the same trend we saw in case of blockchain ETFs too, when Bitcoin was very hot. At least 4 blockchain ETFs launched, but the 2 that were first to market, they were able to gather more than 100 million in assets very quickly within a few weeks. But there were other ETFs which just failed to gather investor attention, and then Bitcoin also languished for quite some time. Same can be said for pot stocks too. They are hot at times, they are not hot at times. So first to market is really an advantage for an ETF issuer if this area picks up and if investors are interested in that area.
Okay, we'll keep that in mind. But let's just say we want to go with the tried and true. We don't want to deal with, the blank check thing and all of that. And we want just the regular IPO market. I know that there are, I have at least 2 that are the main ones, right? The Renaissance IPO ETF, IPO is the ticker. And then the First Trust US Equity Opportunities ETF, FPX. That one's old. I used to own, I want to say I owned both of these, probably knowing my timing. I think I probably owned them in 2014, the last time there was like 300 IPOs. And I was like, I'm diving into this. And then I got bored after like 2 years, or it didn't do that much. So I was like, I'm selling this. So then I did sell. But there are, and I'm reminded of like how different these 2 ETFs really are. Like they're not even really other than owning IPOs, that's about all they really seem to have in common. So let's start with the Renaissance one, because that's the one that is super hot this year. That's the ticker IPO.
Right. So before I explain how that ETF selects and weights its holdings, just a quick word about the investment case for IPO ETFs. So these ETFs, they provide a low cost and convenient way of getting diversified exposure to these IPOs, because IPOs performance, newly public companies, their performance can be very volatile, at least in the first few years of trading, because you learn so many new things about those companies, and also that these ETFs include these newly public companies much before they join other major indexes. For example, we remember that Google was included in the S&P 500 index only after 2 years. 2 years after it went public. Tesla is not yet in the S&P 500 index. It is, though it has been included in the NASDAQ index. So that is the investment case for these ETFs. Now, these 2 ETFs, IPO and FPX, those are the ETFs that provide exposure to US listed IPOs. There are some other which provide exposure to international IPOs. Now, talking about these 2 ETFs, the one which as you mentioned has been very hot this year. It holds the largest, most liquid newly listed US IPOs, and large IPOs are added on a fast entry basis, so within 4 or 5 days, and the rest are included during scheduled quarterly reviews.
Okay, now I do have to say, I was on their website and I did like that this aspect about their website is that they have like a news section, and they did say like Snowflake to enter shortly. Like they are telling you, like, it's coming up soon. It's about to be added. Like they do at least tell you that these big prominent IPOs are about to go into it. So I thought that was cool.
Right. And then it holds companies for 2 years. And after 2 years, companies will be removed. And so if you look at the top holdings, some of the hottest stocks of this year, which have really benefited from this work from home, stay at home, shop online trend, Zoom video, Peloton, Moderna, Neo. These are among the top holdings of this ETF, which kind of explains the performance of this ETF. And let's talk about the second one now, which is by First Trust, which is older, bigger. So what this ETF does is that it holds 100 largest, most liquid US IPOs. Stocks are added after the close on the 6th trading day, and they are held for about 4 years. And then if a company in the index, if that merges with another company, then the resulting entity is included in the index. So if you look at the top holding for FPX, and one more thing, spin-offs are also included in this ETF. And then they are held for 4 years, for about 4 years. So those are the main differences in the two ETFs, 2 years versus 4 years, and the treatment of spin-offs and mergers. So if you look at FPX, PayPal is the top holdings, which was spun off from eBay. And you also see companies like Thermo Fishers because they merged with some other, IPO. So the resulting entity remains in the index. And that is the reason why this ETF has significantly underperformed the IPO ETF, although this has also done very well. It is up almost 30% this year, but IPO ETF is up about 70%. So there is a lot of difference in the performance because IPO, which holds stocks only for 2 years, so it is holding those newer companies which have benefited a lot this year from coronavirus-driven trends, and more mature companies have been booted out of the index.
I also feel like you're getting 100 holdings with FPX versus 47 with IPO. So if one of them takes off a bit more, like Zoom Video has done, and it's now 10.5% of that portfolio, then you're going to have more of an opportunity to outperform versus most of the FPX were, more similarly weighted, and there's 100 of them. So this was
correct. You get a more concentrated portfolio in IPO. So that is why if the top holdings, which account for a lot of weight in the portfolio, if they are doing well, which is the case this year, then the ETF will do well. And if some of the top holdings, they do not do so well, then probably the ETF may underperform FPX. You never know. But there is a lot of difference in their methodologies. So that is something which investors need to understand. Now, this ETF is much smaller compared to FPX. So FPX has over 1.5 billion in assets because it has been older, it has been around for a long time, and there were some years when FPX performed better than IPO, and investors, they chase hot performing ETFs or stocks.
That's right.
So that is why. IPO has about 245 million in assets, so much smaller, though it has also been around for almost 7 years. It made its debut in 2013, but most of its assets, more than 100 million, I think, have come this year because of excellent performance this year. But even though IPOs are so hot, the CTF the CTF has delivered some such excellent performance. Investors are not really pouring money into the CTF. Really, looking at its performance, it remains quite small.
Really? Okay, so that's a bullish sign, though, that everyone isn't like, oh, I need to get in there because Airbnb is about to go public, or, Palantir just went public, or Snowflake, and this is my way to get in. They're not doing it. So I like that.
Yes, yeah, that is a positive sign that investors probably like to wait before putting money in these ETFs. And as you had mentioned earlier that some of the most hotly anticipated IPOs like Uber, Lyft, they made their debut last year, and there was a lot of excitement about those IPOs. So Uber is going public, but unfortunately, those IPOs did not do so well last year. Also, first of all, their valuations were too high, and then this year the equation changed entirely for them, because who is taking Uber or Lyft these days? So that may be one of the reasons why investors are not so excited about IPOs. Luckin Coffee could be one of the reasons, but that was one of the hot IPOs last year, and then we found out about the fraud in that case. So the investors, it seems, they remain wary of investing in the hottest newly public companies.
Yeah. So I looked at the expense ratios on both of these, and they're almost the same. The IPO, the Renaissance, is 0.6, and the First Trust is 0.58. So you're not really seeing much of a difference there.
Very similar. Mm-hmm.
Now, what about the direct listings? Do those go into either of these IPO type of funds? Do you know? Like, the Spotify did a direct listing and Slack did one a couple of years ago. Do those get captured? Maybe even in SPX, they must, right?
Yeah. Both of them, they include direct listings. So Palantir and Asana, which are the most high-profile direct listings of this year, probably they'll be included if they meet other criteria. So they'll be included in these ETFs.
Okay. So if you want only the SPACs, your only option is to do the SPAC ETF. You cannot get those. I cannot get DraftKings in IPO or FPX, right?
There are other ETFs which include DraftKings. The sports betting ETF is one of them. So there are other ETFs you can get. There's another gaming ETF which includes DraftKings, and similarly for Virgin Galactic too. There are ETFs. There are aerospace and defense ETFs, space ETFs, which include Virgin Galactic, but not in these IPO ETFs because they took the SPAC route to go public.
Okay. Yeah, I feel like if someone is going to buy the SPACs or even the IPOs, they're interested in that, and more than one, why not buy the ETFs? At least you're getting diversity. You're not just buying one blank check company where you don't even know what they're going to be buying with the money you're giving them. Like, at least you're getting 36, companies in that SPAC ETF.
Yeah, I totally agree with you. That is the biggest investment case for investing in IPO ETFs or the SPAC ETF, because for every Virgin Galactic, there would be a company like Nikola, which failed totally, and investors suffered so much loss in that company. And similarly, for every Zoom video, there would be a company like Plug and Coffee. So
Yes.
there are always concerns with newly public companies. So it is better to take a diversified route through IPOs. You get an ETF which provides exposure to either 46 or 100 newly public companies, and the performance has been good. I mean, they have managed to outperform. Both of them have significantly outperformed the broader market. So they are definitely worth a look.
Yeah. Okay. And we could still see, some more hotness. October started off pretty hot with IPOs again. So there's more still to come this year. And then we'll see what's happening with the market, the IPO market going into 2021. All right.
Yeah, definitely. I think many companies are rushing to go public before the elections. So October is going to be hot. And I think Snowflake and its backing by Warren Buffett, that also kind of made investors interested in IPOs. So let's see how the year ends for IPOs, but definitely one of the hottest years for IPOs on record.
Yeah. Okay. Let me recap some of the tickers we talked about. So the SPAC ETF is, again, SPAK, not CK as in kitten. Use the K at the end. Then we had the Renaissance Capital IPO ETF, which is just IPO. So that one's easy. Then the oldest one is the let me get it here. The First Trust one, First Trust U.S. Equity Opportunity ETF, FPX. Then, of course, you can just buy like the individual holdings. We mentioned DraftKings, DKNG, Spotify is SPOT, Slack is WORK, Snowflake is SNOW, Palantir is PLTR. I don't know. I think that's about the only stocks we mentioned, but there's a lot of ways to get into these IPOs, and we're going to keep an eye on this area and see if it stays this hot. Maybe we're on the cutting edge this time, Nina. We're ahead of the rest of the pack, the herd. We'll see. We'll see if it stays this hot or if we get a little bit of a cool down here. But as always, you don't want to miss a single episode of The Market Edge because we're bringing you all these hot topics every week, along with stocks and ETFs that you could go and, watch for your own portfolio. And you can get us on Spotify, of course, speaking of Spotify, and you can get us on Apple Podcasts. And you can also get us with the Value Investor Podcast, 2 shows for 1 on SoundCloud, but be sure to get us somewhere, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.